This is the audio version to greater profits in less time on your option trades found at optionsizzle.com. In a previous article, 3 ways to keep more profits and know when to sell, found on optionsizzle.com, I discussed how to take profits on long premium directional trades. I tried pointing out some techniques that could be applied when you're in a winning trade. However, it's not always black and white, and to be honest, it's situational. Sorry, but that's just how it is. Now, for the most part, I like to put on option trades that collect premium. In fact, selling options responsibly via structured trades like iron condors, butterflies, put spreads, and call spreads, I establish these types of positions when I feel option volatility is elevated and or if I have a directional opinion on the stock. For example, if I have a bullish opinion on a stock, instead of paying up for calls, I might look to take advantage of the high option volatility and sell put spreads. Another example when option volatility is high is selling a put spread if it's a relatively low price stock, or will stick to spreads if it's a high priced stock like Priceline or Amazon.com. By the way, if you'd like to learn a little bit more about my process, check out how to sell put options for max profits in shorter time, found at optionsizzle.com, and the SPX method at thespxmethod.com. Now, when it comes to taking profits on these types of trades, I have strict rules in place that I follow. Unlike long premium directional trades, taking profits on short premium trades is not gray. You see, when you put on a short premium option spread, your profit potential and risk are already defined. Before I get into this, I like to quickly explain how one can make money on short premium trades. The first way is option volatility decreasing. The second way, the stock price moving in your favor or not moving much. And the third thing is time decay. Options are said to be a wasting asset. With that said, we don't have to worry about the time decay element. Because we know time always moves forward and option decay accelerates as it approaches expiration. With that said, we can put our focus on finding stocks or underlyings that have charts we like and options that have rich premiums. Why is finding stocks with elevated option premium important? Because a lot of the time you can make money on a trade if the stock doesn't move or even goes against you a little. That's if the option volatility drops. Remember, the higher the option volatility, the more expensive options are. The lower the option volatility, the cheaper options are. For example, on July 28, 2014, shares of Trilla, TRLA, opened up at $63.14. The September 65 calls with expiration to 54 days opened at $6.20. The stock traded as high as $67.50, but the high print of those call options were $6.40. How can the stock rise $4 but the options only trade 20 cents higher than the opening price? Hint, it wasn't time decay. The option volatility dropped significantly. Even though the stock moved higher, benefiting the calls, the drop in the option volatility offset many of those gains. So, are you ready for the best approach? When you're short premium option trades, you'll want to take profits between 40 to 60% of the total premium taken in. That's it. It's nothing fancy, it's simple, and it's easy. In the past, I used to take off my position at 75% of the total premium received. However, my friends over at tastytrade.com had the research team do some homework and discovered that the best area to take profits with the shortest amount of time is at 50% of the premium collected. After I learned that, I reviewed my own notes and trading results and saw that I would have avoided some issues and likely taken advantage of other opportunities if I took profits at those levels. For example, let's say I sold an out-of-the-money $3 call spread and collected a premium of $1 with expiration in 40 days. If the trade started working, I will look to buy back the spread that I sold for 40 to 60 cents. Why this range? Well, a couple of reasons. First, an opportunity for quick profits is there. An option spread losing half its value in a couple days to a couple weeks is pretty common, especially if the options are out of the money and have relatively high option volatility. Second, the risk-reward changes. The third, you can take the range I provided and find your own sweet spot to take in profits. When volatility is higher in the overall market, you might consider the 40% area so you can lock up profits quicker and take advantage of more opportunities. When volatility is lower in the overall market, you might consider the 60% area so you can stay in the trade a little longer because opportunities will be limited. For example, I initially was risking 2 to make 1. Now I'm risking $2.50 to only make 50 cents. In addition, there's an opportunity of cost involved. When you're selling a spread, money is tied up in the form of margin. You see, your capital could be working elsewhere. Not only that, but there is still time left in the spread. Sure, it's likely the options will expire worthless. However, there is also a chance that the stock trades higher and the spread regains that value and even goes in the money. Too many times, premium sellers get stubborn. They think because they sell premium that they're entitled to all of it. Sorry, but that's just not how it works. They either don't want to spend the commissions to close out the trade, or they feel they are entitled to all of it. I can't tell you how many emails I've received over the years from premium sellers who are sitting on good profits, but instead of closing it, they held on trying to capture the entire premium, but only to get stuck in a dogfight. This happens a lot when you're trading weekly options. Weekly options can go from nearly worthless to deep in the money quickly. If you're in a position to take profits in that situation, don't hesitate. In my SPX method, I always talk about taking risk off and buying back those short strikes. Last June, on a Friday, I was at a dentist's office getting 2 of my wisdom teeth pulled on the right side. I had on a weekly SPX IC2 trade, which I teach in the course. The position expiring that day in the morning, the profits were at break even, but as the day progressed, it started to show a profit. On the last hour of trading, my short puts were 15 S&P 500 points away from the market, but I knew I wasn't going to be around to babysit the position, so I decided to buy back the short puts at 10 cents to take off all the risk. Well, what happened next was pretty shocking. A random sell order triggered several market orders over the last hour, and the S&P 500 dropped 20 points. Those puts that I bought back at 10 cents would have been a $3 to $4 loss. That's why I buy back cheap options, because you're always vulnerable to random outliers. After the dentist, I was happy to find that my teeth were the only thing aching and not my trading account. Like I said, I found the best time to get out is when you received 40 to 60% of the premium collected. Remember, the name of the game is to make money as quickly as possible, not to sit on these trades until the risk reward no longer makes sense. By the way, have you ever had a short premium trade on and was too stubborn to take it off when it was profitable? If so, I'd love to hear your story. Also, do you have a method for managing profits on short premium trades? I'll be hanging out in the comment sections below, found under the article at optionsizzle.com.